Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer. The show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, media production specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. I'm here again with Craig Jeffery to talk about SIPC insurance. Welcome to the show, Craig.
Hey, it's good to be back. It seems like we just spoke about FDIC, those four-letter insurance acronyms.
Yeah, I'm wondering how they're similar and how they're different, but we'll save that for the next time. Today, we're going to talk about what is SIPC.
SIPC stands for Securities Investor Protection Corporation, and this is a type of insurance that protects individuals and organizations against loss of cash or securities in case a brokerage fails. Like you have a brokerage account, this provides a backstop for the brokerage. It doesn't protect the underlying assets, but it protects you from the brokerage issue.
So what does that mean as far as coverage? What specifically can you count on being covered?
Yeah, so from a brokerage perspective, let's say you may have an account at a bank and have a deposit there that you earn interest on. That's not a brokerage account. It's a demand deposit or an interest-bearing account. But you also may have it through some type of, let's say, a money market fund or money market mutual fund account through a bank distribution channel. That may be a brokerage, or you may have it directly with Morgan Stanley or some other brokerage. And so your money is put through the brokerage and then it's invested in individual securities or different funds. And so that's the distinction.
So what kind of things don't they cover?
You know, if you said, hey, we've got $500,000 of coverage per customer, that includes $250,000 for cash claims, you may think that this covers a decline in value for your underlying assets. Let's say you have some security or fund. Well, those can lose value. The insurance doesn't cover a decrease in the market value of those securities. It just covers you against the loss in the brokerage account if it's held on your behalf. Let's say it's gone. You suffered a loss because the brokerage suffered a loss, not because the value of the security went down. So this provides coverage to that. So it really protects the custody function of the broker-dealer who holds or custodies these assets for you. So they'll make sure you get your securities and cash back to the accounts when the brokerage firm liquidation happens. So they'll make sure you get the stuff back. It's not like, hey, the firm fails, nobody can find it. SIPC will help you get your underlying assets back.
Is it covering your initial investment?
No. Let's say you put it in a stock fund, like as investing in large cap stocks, and let's say there was a correction, it was down 15%. Now, if the brokerage failed, they weren't custodying it right, and you couldn't find and access the funds, you'd be like, oh, I'm out 100%, let's say $100,000. You're not out that. SIPC will cover you for that, and you'll get those holdings back. But if the thing was down 15%, you're still going to be down 15%, but you're not, you didn't lose track of the holdings that they had. They'll take care of that.
Okay, so basically covering the amount of shares that you had, or
yeah, well, they're a custodian. So they're acting and holding these securities for you, these financial securities for you. If they fail, you still, like, hey, they lost everything. Their records are gone. They shut down. They'll provide coverage, and you'll get back, as the liquidation happens, you'll get back here's your stock that you held. Here's the stock fund you held, or here's the other mutual fund holdings that you had.
Okay, that makes sense. What kind of benefits are we looking at? What kind of limitations?
Well, the benefits are, if the brokerage fails, you're not going to lose your underlying assets. You'll get everything back. So it provides another layer of comfort. That's the benefit. The difference is it won't protect you against the loss that you have, in a market. If you have a market loss, it's not going to protect you against that. You're still bearing the market exposure that you had.
And this is at no cost to the investor. Who's paying for this?
Well, SIPC charges the different brokerage firms. They have a process of paying for it. And so everyone pays for that type of coverage in small amounts, because brokerage failures are not common, but if they happen, they have to be picked up. And so the industry as a whole will cover it. So you don't face a risk of which brokerage I'm at. Is that one going to fail? it's covered, for up to these amounts by the overall insurance at an industry-wide level.
Cool. Well, anything else we should know about SIPC?
It was formed in 1970, so this provided additional backstop in 1970.
Why was it formed in 1970?
Well, there's always been a lack of confidence in different types of methods of investing in securities before then. And there was a significant amount of turmoil from 1968 on with a lot of significant trading and created a lack of investor confidence in securities. A lot of things were processed manually. And so there was a lot of concern about that. And there were some losses. And so this was a way of instilling investor confidence in securities to support the securities market. So if people invest in, equities, they invest in various types of securities, it provides greater ability for capitalism to work, money to go where it's treated well, and for businesses to flourish significantly, and for those who invest to be protected. This provided more assurance across the board, but particularly for medium-sized and smaller investors to be more confident in their investments in the securities market. Eliminating the loss of your underlying assets, eliminating that from a risk is pretty helpful for those that are investing in the market. You're willing to bear the risk that your investments in these individual companies or in this group of companies can go up or down, and you're willing to bear that loss, but you don't want to have a loss of the brokerage went away, and now I've lost all my money. So I bore two types of risks. So this removes one of those risks up to a significant and certain amount.
Yeah, they need that for crypto.
They need that for crypto?
Yeah, that's the issue with a lot of cryptos. They disappear after a while. It was all a scam.
Well, I mean, that's the point too. So you look at some of those exchanges where like the crypto accounts were emptied out. Now you have, where's the backstop for that? Like you face massive volatility from crypto, and now you also lost from the trading house or the firms that were providing those, storing your crypto assets.
Yeah. All right. Well, thank you for sharing this information.
You're welcome.
And to our listeners, remember to tune back every first and third Thursday of the month for another coffee break session.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.